That's what's nice about the moving average crossover. It gives you very clear signals. But what you have to be aware of course, is that Hi, welcome to Let's Talk Forex. I'm Alison, and as always, I'm joined by Chris. How's it going, Chris?
Yeah, not too bad, Alison. How are you today?
Yeah, very good, thank you. So you're in the UK? Is it sunny or?
I'm in London. No, it has been sunny, but it is now raining. It's been raining since yesterday afternoon. People can see it. There's a window behind me. You can't really see that it's raining. It's quite gloomy, but there's supposedly, yes, heavy showers, as we say here,
Okay.
are going to be coming through today. Very, very classic English spring weather. But it's my birthday next weekend, and the sun is supposed to come out. So I'm fairly excited.
Just for you?
Just for me. I knew I was here. Knew it was my birthday. So it's made a special dispensation. So yeah, no, I'm pretty good, Alison. But yeah, today we're going to be diving into one of the most used indicators in Forex trading. And this is called the moving average. And there's a lot to unpack here. But if you've ever looked at a trading chart, then you've probably clocked them at some point.
Yeah, I mean, moving averages are everywhere. But what we often find is that beginners sort of have them on their charts, but they don't really know what they indicate. And in this episode, we want to unpack, how you use them, how you use them to time your exits and your entries. And then, of course, how to filter out low quality trades using moving averages.
Yeah, and the best part is that we're going to keep this episode pretty simple and practical. So whether you're swing trading or you're day trading, or if you're just starting out, you'll be able to have something you can take away from this and something you can apply right away.
So I guess we should start with the basics. What is a moving average? So as many traders may know, the moving average basically is simply the average of the past few prices, depending on the period that you're looking at. And it is called a moving average because it smooths out the average prices.
Yeah, exactly. And there are two types you're going to see most often. One is the simple moving average, which we'll call the SMA, and the other one is exponential moving average, which is frequently called the EMA.
Yeah. So, traders use them in different circumstances. But if we look at the SMA or simple moving average, it gives equal weight to each candle. So, for example, if you've got a 20 period simple moving average, then it basically smooths out the average price over the last 20 periods, and it smooths them out equally. So it averages the price equally over the last 20 candles. And what we find is that it's often slower to respond to changes than the EMA. But it's good if you want to just smooth out the noise.
Yeah. And as you said there, the EMA, on the other hand, gives more weight to recent prices. It's specifically designed to do this, so it can react faster to changes in market direction. And this makes it really useful for spotting shifts in market conditions. But it can also be more prone as a result to false signals. So you've got to be a bit more careful with it, especially in choppy market conditions.
Yeah, exactly. So if we look at the SMA, it's basically better for smoothing out the overall trend, whereas, as you said, Chris, now the EMA, responds to sort of the most recent price movements.
Yeah, exactly. So let's move on to why traders use these. Why are they so popular? So for starters, they're going to help you see the trend more closely. So instead of reacting to every, change in price, whether it's a dip or a spike or anything, you can follow the direction of the average. So really good for trend following.
Yeah, and then they also give you structure. So as you said now, if the price is ranging, then you'll see that the moving average sort of moves up price moves up and down above and below the moving average. Whereas if you see a trending market, you'll see that the price moves above the moving average in an uptrend or below the moving average in a downtrend. And you'll be able to see the degree of trend by how far away the price is from the moving average.
Yeah, and different periods, as you mentioned a little while ago, you talked about the 20 period SMA. Different periods, they give you different perspectives on market conditions. So a 20 period moving average shows the short-term trend, whereas a 50 period will show you the medium-term trend, and a 200 term period trend will show you the long-term trend. So they're useful for all types of trading styles. Some traders, and I think most most experienced traders will use multiple moving averages on the same chart just to see how these trends align.
Exactly. And another thing that a lot of, I guess, experienced traders use moving averages for is as dynamic support and resistance. So you'll often notice that if you go to TradingView and you look at trading ideas, they'll say that the moving average is providing support or resistance at a certain level. And this is also a popular way that trading moving averages are viewed.
Yeah, exactly. And but let's jump into some strategies, some very common strategies for using moving averages. So one of the most popular is the pullback to the 20 EMA. So this one's really great for trend following.
Yeah, I really love this. I don't often use a lot of indicators, but the one thing I do put on my chart is if you've noticed a trend and you've sort of eyeballed that there is a trend on your chart, if you pop the 20 EMA there onto your chart, you'll find that price often pulls back to the 20 period moving average before it continues, and this is great for timing your entries.
Yeah, exactly. So you let that price come back to the EMA. If it starts to bounce off it, especially with the bullish candle pattern, then this is a great time to place your entry.
It's almost like buying at the dip, which it is. That's what a pullback is. But it gives you structure. It gives you a guide. As you said, once you see that, obviously in an uptrend, a bullish candle pattern form, then it gives you a good entry point.
Yeah, exactly. And what you want to do in this condition, you want to place your stop loss just below the recent swing low, and you might aim for a reward or 2 or 3 times your risk. Yeah, so it's really simple. It's logical. It's effective. It's very popular. A lot of people use it.
Absolutely. And the next strategy we sort of use moving averages for is the moving average crossover strategy. This is also a very popular strategy. So you basically use a faster moving and a slower moving average, and then it helps you to time your entries and your exits as well.
Yeah, and this uses the EMA as well, the exponential moving average. So, for example, you've got a 20 period EMA and then a 50 period EMA. When the 20 crosses above the 50, that's going to suggest upward momentum, potentially a buy signal, but you'll probably want other confirmation. When the 20 drops below the 50, then it suggests downward momentum and potentially a sell signal.
And it's a very visual strategy. That's what's nice about the moving average crossover. It gives you very clear signals. But what you have to be aware of course, is that you've definitely got a trend or momentum market occurring. Because if you trade it in a range, it's going to give you a lot of false signals.
Yeah, exactly. No, really important to have some other kind of confirmation here. As you say, in sideways or ranging markets, crossovers, they can lead to a lot of whipsaws. So signals that, so you're going to be jumping in and out all the time, which is guaranteed way to make you frustrated and to lose money. That's why many people will use something called a trend filter, like a higher time frame moving average, or support and resistance zones, whatever you're going to use, just to confirm the setup.
And I find it's very effective if you use it in the right market conditions. Then the next thing you can use a moving average for is to trail your stops. So it helps you to manage your risk and obviously lock in profits. That's what a trailing stop does. But the moving average helps you to sort of calculate the distance behind your entry point.
Yeah, exactly. So say you're in a long trade and the 20 EMA is rising, and you simply move your stop up along with the EMA. And if the price closes below the moving average, then you exit the trade. Pretty simple stuff.
Yeah. It is. And what's nice about it is that it keeps you in the trade as long as the trend is moving in that direction. And as soon as the trend changes, of course, then you'll be stopped out, hopefully with some profit in your pocket.
Yeah, and what I really like about this is like all good Forex trading strategies, it's completely objective. It takes all the emotional out of it. If you're not guessing, you don't have to hesitate, you don't have to pull any triggers, you've got a rule. If the price crosses below the line, you're out. That's it. Yeah, very, very good, I think, for people who struggle with discipline.
Yeah, and then it also helps with trade filtering. So you can use them to decide basically when you don't want to take a trade.
Yeah, filtering with moving averages is, so for example, if you want to use, let's say, a 5-day moving average, you're trying to buy, you maybe want to think twice because that short-term momentum might be against you. You want to wait until the price moves back above the average.
And you can also use the which is a very popular strategy, is to use the 200 moving average as a longer term filter. And you only take trades when the price moves above it, or takes, long trades when the price moves above it, or short trades when the price moves below it.
Yeah, it's all about, we talk about this a lot. It's about lining your trades with the big picture, making sure that you're not trading against the trend. When you filter your trades this way, you avoid fighting a dominant trend that may not be visible in smaller time frames. And this will dramatically improve your win rate.
Absolutely. So just to get into our final thoughts on the moving average, they're very powerful indicators if they're used correctly. They can help you to define your entries and your exits. They can also help you to filter out good and bad trades. And they can help you to set up your risk management.
Yeah, exactly. But look, they're not, like all indicators, they're not a magic wand. They're not going to fix everything and magically provide you with profits. They lag behind price. So, that's always a fairly major issue. And they will not work in every market condition, as we discussed. Like, they're not very good for ranging markets. So you really want a trending market for them. But with the right market context and discipline and other confirmation, they can be a really powerful part of your trading toolkit. They should be, if they're not already.
And then you also just want to start with a few. You don't want to clutter your chart with moving averages. Start with the 20 EMA and the 200 EMA. And this will already give you enough signals to make good decisions.
Yeah. And above all, combine those, as always, with good risk management, right? No indicator is going to function perfectly every time. But if you stay disciplined and you stick with your plan, then moving averages will help you stay on the right side of the market. And more often than not, they'll provide you with a pretty good win rate.
Thank you so much for joining us. If you enjoyed this episode, please give us a thumbs up and remember to subscribe, and we'll see you in the next episode.
Sounds good. Talk to you then, Alison.
Cheers, Chris.